return. So let's say we have company A assets of 3.3 million maybe, and company B have 800,000 value, fair market value, right? Investments. So investment in A has done the investment in B as $700,000, right? So B have nothing in this, but in the balance sheet of A, there will be $700,000 of investment in B, right? So total assets will be $4 million and $800,000. And let's say liabilities are $1 million and $100,000. Equity is $3 million and $700,000. So total is $4 million and $800,000. Now you have to make certain adjustments to get the consolidated balance sheet of AB. What are the adjustments? First of all, if you see this goodwill, there will be a goodwill of $200,000. So here you will be debiting or crediting. So in order to increase the goodwill, you have to debit it. So $200,000 will be debit. And this equity, since you are consolidating, intercompany transactions needs to be removed. So this 700,000 should also be removed. So in order to remove it needs to be credited. And this equity 700,000 is with the company A itself. So this needs to be debited to remove it. And there is a non-controlling interest of 30%, that is 300,000 that we discussed above. This 30%. This will be reported. So this needs to be added. So it will be credited for equity to increase the liability equity. And there was this increase in the value of the assets, fair market value of the assets by $100,000. So there will be a debit of $100,000, right? So if you see debit is equal to total of the credit, so you can consolidate it now. So how to consolidate? Whatever A's assets are, B's assets are, debit minus credit. So here you will be having 3.3 million plus 900,000, which is 4.2 million. Investment will be 0. Goodwill will be 200,000. So total assets will be 4.4 million as a consolidation. Liabilities 1.1 million. This 700 and 700 will be nullified, because so for liability it will be minus debit plus credit. For assets it will be plus debit minus credit. So 3 million plus 7 minus 7 will be 3 million. And 0 plus 0 minus 0 plus 300,000 will be $300,000. So total $4.4 million. Okay. So consolidation is required if the value is, if the shareholding is more than 50%. So either you can do the consolidation or you can use equity method for consolidation purpose, for more than 50% also. Okay. Then a major thing we have, so this is for the balance sheet. Now, if we talk about income statement for consolidation, how the or together income statement and balance sheet, there may be certain intercompany transactions that needs to be adjusted. Okay. So for example, again, let's take this example only. Let me use another sheet for the same. For example, we have company A having 70% of B with $700,000 of investment at the beginning of the year, and same $300,000 is for the remaining. So total is $1 million value of the B, right? And $100,000 the different. So this is the fair market value. Book value was book value was 6,000. Sorry, this is the sale price, purchase price, and let's say fair market value minus book value is $100,000, and so from here we can calculate the goodwill. We can calculate as we calculated above. Let's say goodwill is also given as $200,000. Okay. So same figures with revenue A, B. Let's say we have a revenues of 10 million, half million, expenses of 8 million, 0.3 million, and income from B. And so this is at the end of the year. Try to understand this, that this you have purchased in the beginning of the year. Now you have to consolidate at the end of the year. So at the end of the year, whatever B has earned will be gone in A as an income from B, right? So it will be, let's say, 0.14 million. So total of revenue 2.14 million and 0.2 million. Okay. Now let's say in this revenue portion, the intercompany transaction was 20,000. That means A earned $20,000 from B. So you have to make the adjustment for that. Obviously, that amount should be reduced, right? So for one, it is revenue. So for second, it will be an expense. So from both, you will be removing it. Okay. So 10 million plus 0.5 million minus 20,000 will be 10.48 million, and 8.3 minus 20,000 will be 8.28 million. Okay. So idea is adjustment. If we talk about income statement, there will be a double impact. It will be impacting revenue in for A, then expense for B. Okay. Or maybe revenue or maybe some balance sheet item will be adjusted. So there will be a two-way connection between these consolidation. Okay.